Last year, we closed over 9,000 transactions. That's 4.5 transactions per business hour. And with that type of deal flow, we attract capital. We attract capital from borrowers, and we attract capital from lenders. So Marcus and Millichap Capital Corporation closed $6.5 billion in transactions last year, and that represents debt and equity, over 1,700 loan originations. So there's no better place for users of capital and providers of capital to meet. So with 9,000 transactions and 1,700 loan originations, what does that give us? It gives us a lot of data. So because of that, our research is considered best in class. We have over 900 pieces of research going out every year. And the great thing about our research is that it's in-depth, it's robust, and it's real-time. So with all of that, we're here to present to you a jam-packed agenda. And part of the process of giving you research and information is to get you better informed and help you make better investment decisions. So across our 80 offices, we have 2,000 agents that are all on one fully integrated centralized platform where we share and collaborate not only information, but more importantly, our inventory. And the goal is to have each and every one of our agents have the best thinking of the firm. And hopefully that translates into each and every one of our clients getting the best thinking of the firm. So we have today a jam-packed agenda with an all-star cast. We have professors, economists, market makers, developers, advocates, and they're all going to give you their point of view of what's going on in the marketplace. Because there's a lot of risk out there. There's global risk, there's investment risk, interest rate risk, inflation risk, a lot of risk. So we're here to give you that information so you can make better decisions, you can take advantage of the opportunities in the marketplace, and mitigate any downside risk that you might have. But before we do, I would like to show you a book that we have with 600 of our exclusive new listings. You can get it at the back table. And the one thing that unites us all is our thirst and our hunger for deals. So we have over 600 listings across the country. You can get a thumb drive, or you can get one of these books at the back table, so please don't forget to get one of them. So with that, I want to bring up First Vice President and National Director of the Multi-Housing Group, Mr. John Seabury.
Good morning, everybody. Good morning, everybody.
Good morning.
All right, there we go. Am I on? I think I'm on. Thank you very much, Enrique. My name is John Seabury. I'm National Director of Multifamily for Marcus and Millichap. And with the size of the company and the number of offices we have, being a national director means that I do most of my work on a middle seat of a Delta flight at 30,000 feet. But it's interesting because I also am able to sit down and talk with a lot of investors and a lot of owners and a lot of our brokers and understand what's really kind of happening in the marketplace. Just this week, I was in Seattle on Monday, Portland on Tuesday, and LA on Wednesday. So it ends up giving me kind of an interesting kind of 30,000 foot perspective. So what I'm going to do today is go through an economic overview and show you some of the metrics that we're following from kind of that 30,000 foot level. And we don't want to see that. From a 30,000 foot level and how some of these are really affecting the multifamily industry, and then a little bit more on how it's affecting LA and Southern California. If you want a copy of the slide deck afterwards, leave a card at the Marcus and the Millichap table outside, and we will be able to send you a copy of the slide deck. If you have questions, don't hesitate to give me a call. If you want to ask questions, There is the Slido that Ryan talked about. Send those in. I should have a little bit of time, assuming I talk quickly, at the end to take a few questions, and we will try to get to those. Enrique mentioned that book. We've got a lot of investors who are coming out of apartments and going into other product types. They're doing a product type arbitrage, or they're doing a geographic arbitrage and selling out of a low cap rate market and buying in a little bit higher cap rate market. If that's something you're, and I'm not saying I've got clients that are selling their whole portfolio. They're just diversifying a little bit. So I'd encourage you to take a look at that book. We've also got it on a thumb drive, and it's a great way just to kind of look and see what is out there and get an idea of what kind of returns are on self-storage or shopping centers or triple net. So definitely encourage you to do that. As we jump into this, I'm going to start macro, kind of big picture, and then drill down as we go a little bit. So the first thing we look at is consumer confidence and GDP. The straight line is consumer confidence. The bars are GDP. Consumer confidence, very interesting. I mean, that's, if you feel good about something, you're moving forward. You're taking that risk, and it's interesting how that has just trended in one direction, really, as throughout this entire recovery. We had a little bit of a blip in 15 and 16 as we went into the presidential election. There was a little bit of uncertainty, and then once the election was over, it continued on its trajectory. Not saying that it went up because of who was elected, just the uncertainty was eliminated. You can see at the top, it kind of dropped a little bit in the first quarter of this year. You had Powell was coming out and saying we might have 3 rate increases coming in 2019. You had Trump started negotiations with over trade with China, and then you had a government shutdown for about 45 days. So all those things combined kind of made people pause a little bit. And then it seems like we've kind of started moving forward again. And we'll see how much that continues to go. I mean, that's a really high level. When you look at GDP is kind of interesting because you always have people say, well, it'd be better if GDP was higher, which is kind of like saying it'd be nice if we had more money. I mean, it's logical, but the reality is GDP is doing very well. I mean, it was 2.3% in 17, 3.1% in 18. 19 initial projections were about 2.7%, and I think first quarter came in at 3.2, although they're anticipating it might drop a little bit as we continue on. But again, very, very strong for this late in the cycle. What's really driving that is job growth. And we have generated 21 million new jobs since the recession. We have 13 million more jobs than prior to the recession. That's like a whole new Chicago, right? From a perspective standpoint, that's an enormous number of jobs. And unemployment right now is at 3.6%, a 50-year low. And that's really what continues to push us forward. A lot of discussion, a lot of talk about how long can this continue to go. There are 7.5 million job openings right now in the United States, and we only have 6.5 million unemployed. And that doesn't take into account the skills gap and so forth, but that's an interesting dynamic. It flooded a little bit at the beginning of this year. We had I think February dropped a little bit. March came back up a little bit more, 264,000 in April, so that was really, really strong. So it'll be interesting to see how this progresses, but it's been 200,000 jobs per month on average for over 100 months, which is, once again, just very, very solid. When we look at where these jobs are being generated, New York, Dallas, Houston, Chicago, a lot of the major cities. One of the things I'm always looking at on this is not just the number, I'm looking at the percentage, right? So what is the percentage of job growth? Well, you've got some of these that are really strong. Dallas-Fort Worth at 3%, Phoenix 3.2%, Orlando 3.5%, San Francisco 3.6%. Los Angeles at 50,000 new jobs, 1.1%. The national average is 1.8, so LA is a little bit below that. Inland Empire about 22,000 at 1.5%. San Diego at 20,000 about 1.4%. On the right side of the screen are the markets with the least number of new jobs over the past 12 months. 6 of the 10 are in the Midwest. Midwest is doing well, just recovering at a little bit slower rate, or growing at a little bit slower rate. Orange County, 16,000 new jobs, 1% job growth. Orange County's had very tepid job growth for the past 2 years, which is interesting. So definitely something to watch. Cleveland, we were talking about the Midwest. Cleveland was on the right side of the screen for a few years, and as soon as LeBron moved to LA, it seems to be recovering a lot better. Sorry, that was my joke. So when we look at number of new apartments that are being developed, and this is a national perspective, we're going to deliver about 318,000 new units this year. It was about 310,000 last year, about 320,000 the year before. A couple of interesting things on this is that usually that construction trend goes up and peaks and comes back down. It's really kind of come up and leveled off, which is interesting. And our vacancy rate is at about 4.5% nationally. Another interesting aspect of this is of all of those new units that are being delivered, 50% of them are in 10 metros. So think about that. I mean, so 50% of all the new construction are in just 10 metros. And we have a lot of, I get a lot of developers as they travel around, they're like, are we overbuilding? I mean, should I stop? Should we? And of course I'm a broker, I'm like, don't worry about it, you're fine, right? But the reality is that if you look at the number of new construction, the amount of new construction, number of new units being delivered compared to the job growth and household growth, we're still not keeping up with demand. We'll talk more about that in a second. When we look at where these new units are being delivered, it's a lot of markets you would anticipate: New York, Dallas, LA, Northern New Jersey. Again, I look at the percentage. So the percentage represents the new units that are being delivered. What percentage of the existing stock does that represent, right? So you've got a couple of big markets. You've got Dallas-Fort Worth at 3.9%, Northern New Jersey at 4%, Denver at 4%, Orlando at 3.5%. So that's a lot of growth in those markets. The bigger markets deliver a lot of units, but it's hard to move that needle because there's so much stock already there. So New York's at 1.1%, LA 1.5%. Again, national average is 1.8%. Orange County about 3,300 units, San Diego at 4,400 units. So total of about 27,000 units that are going to be delivered this year in Southern California. On the right side of the screen, we see the markets with the least number of units that are being delivered. Again, I think 5 of the 10 are Midwest, and then Inland Empire. Inland Empire's had really good job growth over the past few years. What do we have? 22,000. Where do we say the other slide? 22,000 new jobs and only 2,700 new units, which is interesting. No idea who's building 1,500 units in Detroit. We're still looking into that. So what this slide does is kind of bring together the conversation of, you can look at job growth, but the real key is household growth, right? So let's talk about household growth for a minute. What household growth is if when we went into the recession, you started hearing about people doubling up. You had 3 generations living under one roof. You had more people living together. As the economy recovers and people start moving out, then those people start expanding and going off on their own, and that really creates that expansion of households. What the bars represent is the total number of dwelling units delivered to the market each year. So single-family homes, new single-family homes, as well as multifamily units that are being delivered each year. So if you can see what happened in 405 and 06, we were delivering so much more than we had demand. And that obviously led to a lot of high vacancy and led to also contributed to the recession. If you look at what happens in 10, 11, 12, it balances out. And really at that time we were just pulling the slack in from the rope, right? But then we hit a point in about 15, 16 where we kind of hit that stabilized level. Yet now we still have household growth growing at a much faster rate than the new units that were delivered. So in 2018, we had, I think 1.1 million new units delivered and 1.2 million new households created. In 2019, it's 1.45 million new households created and 1.2 million new dwelling units created. So this year, in 2019, we will have 250,000 more new households than new dwelling units. Which is part of the reason that we continue to have this upward pressure on rents, on occupancy. And one of the interesting dynamics of this is if you look at
long-term vacancy for Class A and Class C apartments. Historically, they've run parallel, but Class C vacancy is generally higher than Class A. So this goes all the way back to 2002. And then, and this is a national perspective, look what happens in 2016, they invert, right? And Class C continues to drop on vacancy. So 2013, nationally, Class C vacancy was 7%. Class A vacancy was about 5%. 2019, Class C has dropped all the way down to 4%. And Class A is at 5.1%. And there's a couple of dynamics there. One of it is, of all of the new units that we're delivering, single family and multifamily, they're really all Class A units. You can't build Class C. You know, the old joke is, how do you build Class C? You build Class A and wait 30 years, right? So another dynamic of that is historically, as a cycle starts to come back, people would move out of B and C product and move into single family homes. Well, that's not really happening now at the rate that it has before for a lot of reasons. Some of it is social. People are not as prone, they don't feel like they have to go buy a home. Part of it is economic. As a result of new regulations, Dodd-Frank and so forth, it's much more difficult to qualify for a single family home. So people are staying in those Class C product, and we're not building any more of it. And if you look at the household growth numbers, only a percentage of those people can actually afford the new units that are being delivered. Right? If you look at the total number of units that are delivered today over the last 3 years, the total number of dwelling units, about 27% of those new dwelling units are apartments. In 04, 05, and 06, it was about 9%. So the percentage of new dwelling units that are apartments has tripled. But we're still, once again, we're still not getting to that point of where we have any kind of supply equaling demand. Shifting a little bit, what this is looking at is total number of transactions and number of multifamily transactions throughout the country. And a couple of interesting things on this. One of them is that the 2009, or 2016, I'm sorry, was the first year since 09 that the number of transactions dropped. But it just dropped a little. I mean, it's a very, very small amount. The more interesting part of it is the fact that we've kind of hit a high watermark, and then we've stayed there. You can see 2019 comes down a little bit. We're still within 2% of where we were in 2015. And we're still about 5% above where we were in 2005. Usually, transaction velocity diminishes when the fundamentals diminish, right? So as you start getting, as your apartments and the operations start getting deteriorated a little bit, then that starts pulling back. We don't have that. Our fundamentals continue to be very strong. Occupancy is very high. Rent growth is very good. Opportunities continue to exist. Interest rates are extremely low. So we've kind of hit that high water mark, and then we've stayed there. One of the interesting parts of it is that in 2009 and 10, about 38% of all 15 million plus apartment sales were in secondary and tertiary markets. 38%. 2019, 60%. So what's happening is investors are chasing yield. They're pushing farther and farther and farther out from the metro area, trying to find the returns that they're going to be able that they promise to their investors. So you guys understand how that works, right? Chasing yield means you call your investor and say, I think I'm going to be able to get about a 7% return in Santa Monica, right? And then you call them back 3 weeks later and you go, well, it's a 6% return in Riverside. Right? You go back 2 weeks later and you're like, have you ever been to Barstow? Gorgeous this time of year. Right? So that's chasing yield. That's happening all over the country. A conversation I end up in a lot is cap rates can't go any lower. The returns, they don't make sense. They're way too low. It doesn't make sense. And what you have to realize is you've got to look at the big picture. So historically, 15, 20 years ago, large institutions, pension funds, sovereign wealth funds, only had a small allocation going to real estate. And the amount going to real estate was really going into office, retail, and industrial. What's happened in this cycle is a lot of those large pension funds, big institutional money investors, have been allocating a lot more money going into real estate overall, and then a bigger chunk of that, a part of that real estate allocation is going into apartments. And if that's happening at the very top level, that's putting pressure all the way through the stack, right? And the reason they're looking at that is that right now across the country, cap rates on multifamily are averaging about 5.1%. And if you're one of those large funds, comparing that to US Treasury at 2.2 or 2.1 this morning, I think, S&P dividend at 2.0, Canadian Treasury 1.7. So we are looking at it from the standpoint of historical apartment perspective, and we're saying this doesn't make any sense. I mean, these returns are really low. Meanwhile, you have this other large money looking at apartments and saying that's a better return than I want to get anywhere else. So that money keeps coming in at the very top, and then the smaller investors keep pushing farther down into the private capital sector, which is an interesting dynamic. Another perspective we're watching is just a demographic shift that's been taking place. So what this chart looks at is in the year tranches that we have broken out, what percentage of all the new households went into the suburbs, the urban areas, and the rural areas. And so if I start with 2000 to 2010, 77% of all the new households were in the suburban areas, 8% in the urban areas. 2010 to 2015, that urban growth jumps up to 21% of the households, which is huge. And if you could look all the way back to 1970, that's 3 times the average over a 40-year period. So we had this huge influx pushing into that urban core. As we look at 2015, 2025, it's pulling back a little bit. You've got a little bit less growth that's probably going to be taking place in the urban areas. It's still going to be very strong. And then about 80% of the people are going to be in the suburban areas, about 80% of the new households. Rural areas, that just continues to diminish. I think a lot of times young people like the idea of living in a rural area, of simplified life, and then they get out there and there's no Thai food or Wi-Fi. They're like, yeah, this is not going to work. This chart is kind of the same thing as the previous one, but this is just looking at population growth. So on the left side of the screen is total population growth, and on the right side of the screen are young adults, which is the 20 to 34-year-old age cohort, which is always important. We're always tracking that because those are primary apartment renters. But if we look at 2000, 2010, on the left side of the screen, total population, about twice as much of the population growth was in the suburbs. But during that time, twice as much of the younger people were going into downtown areas, right? And if you look at 2010 to 2018, they kind of even out a little bit. The growth was about the same, and the young people were averaging out as well. The interesting part is, look at 2018 and 2023, it's back to a more of a kind of a historical amount, whereas more growth in the suburbs, but the young adult population is actually expected to decrease a little bit in the urban core. Now, there's a couple of reasons for this, and I'm not saying, get out of the downtown area, it's going to be bad. It's not going to be bad. It's going to be fine. It's going to be great. But first of all, many of the people that were considered young adults in 2010 to 2018 are still living downtown. They're just no longer young adults, right? They've aged out of that age cohort. Another aspect of it that we really didn't see 20 years ago is the number of people that are becoming empty nesters, selling the house in the suburbs and moving downtown, right? And that's really been fueling that downtown area. And then there's obviously that segment also of the young adults who are living downtown, and they said, I'm gonna have a low carbon footprint, I'm gonna ride my bike to work every single day, we're gonna raise our family in the city, and then you have a Subaru station wagon and a Costco membership in the suburbs, right? Because that is definitely happening. That trend is also happening. If we dig down into what's happening in Southern California a little bit, what this chart is looking at is job growth, employment growth. And so on the right side of the screen is that average annual growth over a 9-year period. And Southern California really outpaced the national average, 2.1% against 1.6%. A little bit of the concern is that Southern California has slowed down a little bit in the last year. So in the trailing 12 months, you've got Southern California at about 1.2%, the national average at about 1.8%. And it's not a major concern, but it's something that's kind of popped up on the radar that we're looking at a little bit. When we look at new construction, about 27,000 new units are going to be delivered across the Southern California in 2019, and about 24,000 last year, about 15,000 year before, but then a little bit higher before. A lot of new units coming online. There's still a very robust pipeline, and that's happening in Southern California. A lot of those new units are Class A. Once again, very, very difficult to build Class C. And that vacancy rate remains very, very low. And this is kind of a culmination of a little bit of the struggle that's happening in Southern California right now. Is job growth over the last 5 years has been very, very strong. We just have not built enough units, especially for kind of that workforce housing. And by the way, I don't think anybody's going to disagree with me in this room, but rent control is not the answer, right? But if you look at this, the delta between new dwelling units and new jobs in Los Angeles over the last 5 years is 287,000. 135,000 in Orange County, 200,000 in Inland Empire, and 125,000 in San Diego. It's basically about a 4.5 or 5 to 1. So for every 4.5 or 5 new jobs we're creating, we're delivering 1 dwelling unit. So it's if you own B and C quality product, that's good. You're going to continue to have upward pressure. But there's also an aspect of a long term of this is something that's going to need to get worked through in order to allow continued growth in Southern California. We show this on a national scale, and when I show this chart on a national scale, everybody kind of wants to know what it looks like on their local scale. So Southern California is a little bit different than national. It's actually just ahead of the curve. It's a little bit more progressed, a little bit more mature. So 2013, there was about 5.5% vacancy on Class A and about 4.5% vacancy on Class C. Today, Class C in Southern California, 2.3% vacancy. And that's like none. That's like almost zero, right? And that pressure has continued to, and again, creates a lot of opportunities, but it also creates a little bit of pressure, I think, from an economic standpoint. A very positive aspect for Southern California, though, is also the affordability gap. So affordability gap is what's the difference between the cost of renting and owning. So on the screen are the least affordable markets when it comes to that affordability gap, which means they have the largest gap between the cost of renting and the cost of owning. Very top of the list is Manhattan and San Francisco, San Jose. Orange County, San Diego, Los Angeles are all on the list. So this is the top 10. So throughout the country, 6 of the 10 are, or 5 of the 10, I think 6 of the 10 are California. And 3 of the 10 are Southern California. And so there's some good and bad with that. The positive aspect of it is this is why people rent longer in California, right? It's just a really big jump. You can see that national average is $442. If you're in the Midwest, if you're in St. Louis, the difference between the cost of renting and cost of owning is like $20. So when you're in California and it's $2,700 a month, all of a sudden that keeps you in that apartment for a lot longer period of time. That's a positive dynamic for owning apartments. Historically, in a lot of the Midwestern cities, when you have a lot of new construction of single-family home, everybody's moving out of C-grade apartments into single-family homes, right? So that's an aspect, in my opinion, that creates a lot of positive influence, I think, in Southern California. When we look at the transaction velocity in Southern California, it's been very stable. It's interesting because transaction velocity usually goes up and it comes back down. Once again, it's kind of come up and hit a high water mark. So this is Southern California, apartments, $1 million or more. And I think we've got like 2,700 units, or I'm sorry, 2,700 transactions annually that have taken place. When I talk to investors, it's very typical that they say, oh, I think velocity's really dropped off. I mean, I don't, 4 years ago I was buying 3 or 4 deals a year. Last year I only got one. Velocity hasn't dropped off, it's just the number of buyers in the marketplace has dramatically increased. Right? A lot more competition, a lot more investors chasing apartments. So that's one of the dynamics that has come into play. But it's interesting that velocity really hasn't dropped, and I show it just because so many investors will, I end up in that conversation so many times, and they see that and they're a little bit surprised. So, kind of wrapping up, what this chart shows is long-term cap rates for preferred primary, secondary, and tertiary markets throughout the country. And you can see what happens is we go into the recession and those cap rates jump up. But then immediately they drop down in the preferred primary markets. So what happened is immediately following the recession, you had a lot of institutions, pension funds, putting large amounts of money into Class A product and Tier 1 cities. The interesting dynamic on this is that 2012, the delta in basis point between preferred markets and tertiary markets was about 370, whereas today it's only about 190. And if you look at where that compression is taking place, the majority of that compression is in that secondary and tertiary market. So here's the point. As I'm traveling around, the kind of a funny comment that I get all the time is I will literally be sitting at a dinner with 30 people. And I have somebody looking over and go, hey, listen, where's the best place to buy? I'm like, all right, don't tell anybody, right? You go into the viaduct, you ask for Eddie, right? He'll show you the land of the 8 caps. As if there's like a secret place out there that you can go buy returns. Everybody's totally convinced, there's got to be a place. The reality is we are late in the cycle to a point that the water table has risen, and there's really no, 3-4 years ago, we still had a few markets. Atlanta was a little bit late coming into the cycle. Jacksonville was a little bit late coming into the cycle. There were a few markets that we could tell still had legs. But at this point, pretty much everything is at equilibrium. So here are the 2 areas that I would say I think we are still going to have value. We're still going to be able to have a little bit of cap rate compression, assuming the Treasury didn't change much. Is that number one, if we had a big map of Southern California and a bunch of markers, I would be able to, you would be able to determine collectively where the primary, secondary, and tertiary submarkets are throughout Southern California. And I think a lot of those secondary, tertiary submarkets are probably going to have continued cap rate compression, right? They're the neighborhood that you drove through 4 years ago and thought, oh, I'm not investing here. But if you drive back through, you're like, where'd the Starbucks come from, right? The second part of it is that secondary and tertiary market, we're going to continue to see more and more investors go into the secondary and tertiary markets because those economies are doing much better. Those economies are starting to see more and more job growth. And you don't have quite as many investors that are chasing the deals in those markets. The last comment to make is, if you look at long-term cap rates and the long-term 10-year treasury, we still have positive leverage. So returns are low, cap rates are low, but the 10-year treasury is incredibly low. I would never have guessed 3 years ago that it was going to be down to 2.1. So I think that's a dynamic to keep in mind, is that we're not going to have the returns and the upside over the next 3 years like we did 4 years ago. That part of the cycle is already played through, but that doesn't mean that there's not going to be really good investments. That doesn't mean that you're not still going to have strong job growth, rent growth, and solid returns. So, and with that, do we have any questions? Anybody send anything I don't want to slide out? The easy ones, preferably. Yes.
Expect the vacancy on the Class A to stay around 5%.
I think that the number of new units that are being delivered in Los Angeles and in Southern California, there's a lot of new construction. Her question was, do I think Class A vacancies are going to stay at about 5%? And
And I know that there's already some new construction that are giving 1 month, 2 month, even more than that on concessions. I think we're gonna have a little bit of softness. But as long as we have continued job growth, and as long as we have continued pressure, I don't think it's gonna, maybe it goes to 5.5 or 6 or something like that, but I don't think it's going to end up being an issue or a problem. One of the things you've got to take into consideration compared to previous cycles is also that lenders are far more conservative in their underwriting today than where they were in previous cycles. They're requiring a lot more equity going into deals. They're underwriting deals in a much more conservative fashion than what they did before. So as a result, you've got more equity in the deals, and I think developers are a little bit more cautious. But I don't, I could see that going up a little bit, but not an enormous amount. So on balance, does it make more sense to build or buy today? New development versus value add. That's just it. I've had a lot of investors who have told me over the past 6, 8, 10 months, look, it doesn't make sense for me to buy anymore today. My returns just aren't there. We had a dinner last night with a handful of people and was talking to an investor, and he said, I've actually started building. I think he built a deal in Texas and he built another deal in the Carolinas. So I'm hearing more and more investors that are pushing towards the new construction side of it. But everybody is in my position, it's actually kind of funny. Once a week, guaranteed, I get a call from an investor in New York who says, hey, I'm thinking about getting into apartments, and what I want to do is I think I'm going to go out and buy value add deals. Wow. There's and they just don't realize how mature the process is, how far down the path we are on that. So I think everybody's still looking for a really good turnaround. They're looking for a really good value add. You're having to dig a little bit deeper. Our brokers are developing those relationships, and a lot of what's happening is private capital, kind of mom and pop operators are selling to a more sophisticated not institutional, but a more sophisticated investment fund. What is the forecasted impact of rent control on multifamily valuations? I am going to punt on that because we've got a panel this afternoon that is an amazing panel with professor from USC and Kimball Ratliff of NMHC, and as well as a large owner in the market. So I think we will dig into that a little bit deeper. But it's interesting. I mean, it's definitely something we have to watch and we got to keep an eye on. How attractive is the outlook for multifamily investment in SoCal versus other markets around the country? SoCal is an interesting market because you don't have as much outside capital coming into this market. Part of the reason is your cap rates are lower than most other markets. The other part of it is it's a higher barrier to entry. It's a complicated market. Southern California, San Francisco, New York City, you don't have investors coming out of Denver and buying here because once they get in and they see all the laws and regulations, they're like, wait a minute, this is a little bit more complicated. So I think the outlook is still very positive. I think that the values are still very strong. And probably one of the best things about it is you're not going to have an enormous amount of outside capital coming in because sometimes that pushes values a little bit higher than they do otherwise. What cap rate, with cap rate so low in LA, who are the buyers buying? Existing owners exchanging to improve their building location? Are they new buyers, uneducated buyers? Yes, they're all of them. It's funny when I sit around and I talk to investors in a market like this, and a lot of the returns are so low. And then we had a dinner last night with about 15 different owners, and everybody went around and introduced themselves, and then said if they were a net buyer or a net seller. Every single one was a net buyer, right? So the buyers in the marketplace today are you, right? Everybody here is looking for that next deal. They're looking for a really good return. They know they're not going to get as great of a deal as they had 3 or 4 years ago. But you are still considering to look for that. Yes, there's some new money. Yes, there's some of that new money that's a little bit less educated. But for the most part, we're not, lenders are still fairly conservative in their underwriting. We are not selling deals that we're like, oh my gosh, there's no way they're gonna make it on this. For the most part, it's educated investors just like yourself that are continuing to push, sharpen their pencil, and look for that next deal. So with that, thank you very, very much. Greatly appreciate it.